It all comes back to the DNA. The firms that know who they are will know who to be. You can learn a lot about an investment firm by listening to what they say. Alpco's Mainstream's AGM Originals, The DNA, Capturing Culture, is dedicated to capturing the DNA of a firm by listening to what they say. The first season of The DNA stars EQT, a global investment firm started in Stockholm in 1994 that has over 270 billion euros in AUM. I sat down for conversations with 9 EQT executives in Stockholm this past summer at their annual investor meeting. Each executive came from different parts of the firm and different parts of the world. Each had fascinating backgrounds and stories about how they ended up in private markets and working to build EQT. But there was a single through line threaded throughout all the discussions: the consistency and frequency that each executive talked about the firm's mission, vision, culture, and values. Episode 6 of Season 1 of The DNA stars Hari Gopalakrishnan. Hari, welcome to the show.
Thanks, Michael. Thanks for having me.
Pleasure to have you. I think we have such an interesting conversation on tap today because India is such an exciting growth market. You've been investing in that region for quite some time. You've also seen the broader Asian private equity growth story. And now you're part of a global platform at EQT. So we'd love to get into it. First, I think we'd love to start with your background and hear how you got into the private equity world.
So I was born and raised in India. I grew up in a small town in the south of India. And so right after business school, I knew that I wanted to get into the buy side. But I was really excited by public markets. So I interviewed with this first-time fund that was focused on India and had big presence in public markets. I interviewed with them and they said, "Hey, sorry, we don't have an opening in public markets. Why didn't you try private equity?" I said, "What's private equity?" Because the industry was so nascent at that time. And there were only 4 funds in India in 2005. And I joined the private equity practice there. And then 2 years later, I joined the betting team.
What was different about what you maybe thought private equity was going in and when you actually started investing in private equity?
In 2005, private equity was not well understood. There was a mix of venture, there was a mix of buyouts. The market in India was very venture-led. And so we started doing minority transactions. And we felt that to be true fiduciaries of our investors' capital, we needed to have better control of underwrite and better control of the exit timing. So we then started doing buyouts. That was a big transition that happened.
How much of a mindset shift is that from both the perspective of how you work with a company, but also from the perspective of are there benefits to being a minority investor and then learning how to become a majority or control investor?
So that's an interesting question. I would say that the mindset shift is significant. When you shift from that minority mindset to control mindset, one of the things that I've experienced is, the buck stops with us. We have to figure out a way to make it work. You basically have to underwrite, and we have to have higher level of confidence in that assumption.
It's interesting, though, because I think this is heritage from BPEA as well as EQT, which is this element of really partnering with the business. So yes, when you're a control investor, you have the ability to control the destiny of the business in a way that you don't as a minority investor. But it does feel like there's some elements of being a minority investor that has helped influence how BPEA and EQT both thought about how to partner with operators and founders.
Yes, definitely. In Asia, the market was minority, especially in the growthier economies. And it was buyout in some of the more mature economies, right? And so within our fund in Asia, we had both mature and minority investing. And I think both parts of our firm benefited from that. The minority investors benefited from that buyout mindset, and the buyout investors benefited from that mindset. And I would say that attracting and retaining management talent is really a big part of a success as a buyout firm. And partnering with management teams and CEOs and chairmen and board members that has really, helped us carry everybody with us, give them a shared vision, and build that grounds up. And it's part of that Wallenberg heritage as well. Wallenbergs have friends in wherever they go, and that has influenced EQT, and that's part of the Bearing culture as well. So that's helped us make friends everywhere.
What's also interesting about the Indian private equity market structure, which is somewhat related to what you just said, is that there's no ability to take on debt. You can't do leverage buyouts. How does that impact the Indian private equity space?
Again, I would say that one of the greatest benefits of investing in India is that structurally there is higher growth in India. India today is the fastest growing large economy in the world for the past 4 years. And there are some estimates that say that India will be the fastest growing economy for the next 3-4 years as well. So intrinsically, if you have an economy that's growing well, revenue growth is one big source of value creation. So for domestic facing businesses where leverage is not available, we underwrite to higher growth. Again, I remember when I finished my undergrad, India was about $450 billion. That was the size of our GDP in 2000. And we had 1 billion people, so per capita GDP was $450. That's $1.50 a day. Okay, from there, 450, we're now 4 trillion. So that in 25 years, we've grown from 450 to 4 trillion. And that growth has become a tailwind for all the businesses that we invest in.
How does investing in a growth economy change how you might think about investing in private equity, and perhaps unpack that in the context of you may be private equity investors, but maybe there's a bit more of a growth mindset?
Yes, again, it comes from our heritage as a minority investor and partnering with management teams. In general, we feel that close to 60% of global growth will come from Asia. Okay, so for across Asia, there is that growth tailwind. 2/3 of our returns have come from revenue growth. Achieving that revenue growth has always been key to our underwriting success as well.
So you talked about tremendous growth over the last 25 years, 450 billion to 4 trillion GDP. What does the go forward look like from a growth perspective in India, and where does that make it interesting to invest into?
So if we continue growing at the same rate as we are, over the next 20 to 25 years, India will become between 12 to 16 trillion in GDP. Okay, so that incremental 10 trillion GDP growth can happen in the next 20 years. So what we did in the last 20 years is 3.5 trillion. We can actually do 3 times that in the next 20 to 25 years on a larger base. Okay, and that 10 trillion opportunity is the size of the price in India. That's not available in many markets. Again, if you look at the population structurally, India, the median age is 28 years. In Europe, the median age is 45 years, for example, right? And this 28-year-olds, we have 1 billion people in the working population, which is close to 4 times what you have in Europe, for example, right? As these people start entering the workforce and build their careers over the next 30 years, we think it will result in a compounding growth of the economy. So I really believe that the next 20 years are going to be even better than the past 20 years.
It sounds like it might be India's time when it comes to investing. Demographics are often destiny, but that destiny is also related to how you think about investing. What's the destiny of how you think about investing if you think about all those demographic trends that you just laid out?
So one of the great things that has happened in India over the past 10 years is we've had policies and policy stability and the government that is very business friendly for the past 10 years. That's really propelled our growth. And so what we have done over the past 15 years is to always select sectors that are secular. So our 3 core sectors in India are tech services, financial services and healthcare. In tech services, we've been working on this for 15 years. In healthcare, we've been focusing on healthcare for 10 years. So we pick under-penetrated secular sectors and build experts in those sectors. And then as these young workers enter the workforce and their disposable income increase, we believe that there will be more discretionary spend. So we're looking at more consumer-facing businesses. Healthcare again is an important part of discretionary spend, and we're looking at other segments that build off our existing capabilities like software. So overall, I would say our aim has been to strengthen our franchise in our existing verticals and build into new sectors like consumer-facing businesses, industrial tech, software, etc.
When I hear about the investment opportunity in India, my mind goes to two places. One, the GP's perspective, and two, the LP's perspective. So let's talk about the GP's perspective. This opportunity set seems so large that I have to imagine that a lot of GPs look at India and say, wow, this is a big opportunity. What gives you an advantage relative to others that are focused on the Indian market?
See, we did our first buyout in 2013. We believe we were the first players in the market in India to focus on buyouts. And over the past 15 years, we've done 19 buyout transactions in India in our core sectors. And so we've developed market leadership in tech services, and we're building depth in healthcare and financial services. So that 15 years of depth and track record in these sectors really makes us a safe pair of hands for any LP looking at India today. The other thing I would say is that we've had a stable team that has stuck together. Our average partner tenure is 15 years. So we've been through the global financial crisis. We've been through change of governments, COVID. And so that learning is incorporated within the team over these ups and downs. And finally, it's also being part of an institutional platform like EQT. We have access to resources and talent. We are ahead of the curve in many of our sectors because we have this EQT and the Wallenberg network that we can lean on to.
Let's unpack that a little bit more, because you built the practice that you just discussed at Barings and built one of the leaders in private markets in Asia. 30-year history, similar in how old the firms are to EQT. What made you decide to want to become part of EQT's platform? And how did you think about the merging of those two cultures?
So I would say that when we were considering this option, we felt there was already a cultural synergy between us. I mean, when we looked at the culture of the two organizations, both of them were, young, transparent, entrepreneurial, energetic, and so there was an existing cultural synergy between the two organizations. That was, I would say, the single most important element. And the proof of that is really 3 years after the merger, almost all of our senior team members are still with the greater equity platform. The second thing I would say is that we were already the biggest in Asia, okay? And EQT is a powerhouse in Europe and North America. And the combination made sense in terms of a geographic footprint.
I love it. Well, I think there's so many different elements where 2 + 2 can equal 22. One of those elements is on the LP side, right? EQT has a very large base of LPs, institutional clients, as well as now certainly the wealth channel becoming a bigger part of the business. That, I'm sure, also has helped you as you've become part of the EQT platform, and particularly as it relates to India. I think you've invested more than you had expected as of 2024 when John went on TV and talked about that. That, I think, reflects the opportunity in India. What have you impressed upon LPs about the India story that makes them need to understand, hey, we need to have some exposure to India?
Again, I would say that that 10 trillion opportunity is not available in every market. So that's one. The second is that being in India on the ground for 15 years, we've invested close to $10 billion in India across 19 transactions.
What are LPs missing about India?
I would say initially, a few years ago, India was not as much on the radar. Today, LPs are more conscious of India and more excited about the opportunity in India. So we see a lot more interest in India coming through over the past 5 years, and we are expecting it to continue as well. And so overall, I would say that India is on the LP's radar right now and attracting a lot of positive attention.
Well, I think with any emerging economy, one of the questions for LPs is always exits, right? And exits to some extent are a function of capital markets, and how functioning those capital markets are is their path to liquidity. There's obviously all different ways in which firms can generate liquidity, but one of them is certainly public markets. And you shared this with me, which I thought was a fascinating stat, was there's now 2 million new brokerage accounts being opened up per month in India. So roughly, I think last year was 25 million new brokerage accounts. And then you have the equivalent of 401ks, so retirement money that's now going into the Indian stock market. Walk us through what that means for Indian capital markets and how that trickles down to the private market opportunity.
Yeah, so India has always had a high savings rate, but Indians used to put money more in real estate, gold, and cash deposits. So I remember looking at a brokering business in 2007. The total number of broking accounts in India was less than 2 million. Okay, so we are now adding 2 million every month. And so the install base is close to 125, 130 million today. Okay, so there's a lot more interest in equity culture. And if you look at 1 billion working age population, 120, 130 broking accounts are still small when compared to that. The other interesting thing that's happening is as these young workers enter the workforce, there's something called a systematic investment plan by which they put a portion of their paycheck into equities every month. When markets go down, we've seen that these systematic investment plans don't get cancelled. Okay, so that most people don't cancel these automatic systematic investment plan, which is cut from your paycheck. So that has become a snowball today. That's close to $3 billion a month. So this is domestic capital that is supporting robust capital markets. And we expect this capital markets to get the support from this domestic capital, irrespective of foreign money coming in. The other interesting aspect is we've taken advantage of this. The benefit of having control over your investments is you can determine the timing of our exit and the path for exit. So in our India business, we've had multiple paths to exit. We've sold to sponsors. We've taken companies public and sold down in the market. We bought public companies. For example, Coforge is a business that we sold close to 925 million, close to $1 billion on the market on a single block. Late last year, we took Sagility public, which is our first investment. So capital markets has come as one of the avenues for liquidity. It's perhaps probably not the preferred avenue because sell downs still take time. But it's an important optional value. Today, if you're an investor and you have portfolio companies in North America, Europe, it's not easy to do IPOs in those markets.
So when you're underwriting the investment opportunity in India today, you think about the rapid growth and the rise of brokerage accounts from 2 to 130 million over the last 15 years, 16 years or so. What does that mean today to you in terms of as you think about the next 7 to 10 year cycle when you'll start to harvest investments you're making now? How do you underwrite what the capital markets opportunity will look like then?
I would say that when we underwrite, we don't underwrite any multiple expansion in that respect. We want to underwrite earnings and revenue growth more than multiple expansion. And like I said, a vibrant capital markets is important to develop a strong buyout market as well. So in the next 15 years, I would expect the market to be really deep, both on the private equity side and on the capital market side. And the capital market side are a powerful source of liquidity. That is an alternate pool of capital that is diversified from US and Europe and is also offers us optionality to achieve that liquidity in India.
I want to touch on just the shifting mentality. I think this is true everywhere, and I think it's part why we're seeing the wealth channel start to think about private markets more. But it's this mindset of ownership, of equity ownership, like you mentioned. How has this shifting mindset, especially given such a young population, average age of 28 or so, how does that change your interactions with entrepreneurs and operators? Do they have a shifting mindset because the mindset in India has shifted to equity ownership? So then therefore, as they understand what it means to think about working with private equity, they think about the building of businesses, owning equity in businesses differently than maybe they have in the past?
Yes, I would say it's been an interesting mindset. When we first started investing in India, the market, like I said, was minority, and it was expected that founders' families would inherit their business. Okay, one of the interesting things that we have seen is that as founders' children pursue other interests in life, okay, founders are more interested in finding a new home for their business. They have spent 30, 40 years building their business. Very often their children probably want to live overseas, or they want to do other things that they are excited by. But the founder wants the business to be in a good home. So that's a big mindset shift that we have seen. Again, I would say that there is a segment of high net worth individuals who are today underserved. So there is that prosperous group which is underserved, which we believe can be a source of raising capital in India for private equity. And a lot of funds have already started tapping that HNI segment, even for domestic investing.
What do you think it will take to educate that segment about why they should have some exposure to not just private equity, but private equity at home?
That's already happening, and we expect it to deepen over time. It is really the top 2-3% families that we are talking about, but over time we expect that to widen. What will require probably policy stability, success track record. Co-investment opportunities are important for them as well. So, and a good brand in the market.
What's the hardest part about investing in India?
The hardest part about investing in India is having to make choices. In Fund 7, we had India was one of the biggest contributors to Fund 7, and in Fund 8 again, India was one of the biggest contributors to Fund 8. And staying disciplined on price is really important for us. And so making that choice on which one to pursue, which sector to focus on, is something that we struggle with. Yeah.
Are you finding that other global firms are really starting to invest heavily in India? And maybe does that mean prices are starting to get bid up and you have to really be thoughtful and conscious about how much you want to pay relative to what others might be trying to do in the region?
So in general, I would say India has been discovered by some of our bigger competitors over the last 10, 15 years. The challenge is their conviction on India keeps changing with different sectors, different times, right? We started off as an Asian firm. We couldn't win in Asia without winning in India. So India was a must-win market for us. So we have a local investment committee close to the ground, can react quickly. So we were able to grow ahead of all the other global firms because we were so local and deep in our sectors. In our experience, we have to be really close and deep in our sectors. We should know the assets that we want to go after, the management teams that we want to buy and work with, and then be ready to move decisively when the opportunity comes. And again, having the funnel to do multiple investments means that you can walk away from something if it gets bid up.
What you just discussed is a theme that seems to be threaded throughout the EQT DNA, which is being really close to the companies, the industry, being on the ground, the locals with locals concept. I'd love for you to unpack what you think that means and why that's so important, particularly in a place like India.
So, again, the EQT heritage is to be business owners, and think of it like industrialists, like, what can we build this into? Which means that you really have to understand the levers of the business, what makes it grow, what are the risks to the downside. And the only way to do it is do as much work before as possible. And EQT, again, has a sector-oriented buyout in healthcare software. So EQT has done close to 60 investments in software. So when I'm looking at a software transaction, in India, I already know that playbook. And it gives me a heads up on my competitors in the domestic market.
What skill set do you think you need to have as a private equity investor to do well in India that's maybe different from other parts of the world?
So to be successful in India, it's similar to what I would say in other markets as well. Be resilient, be optimistic. See the things that others don't see. That I would really encourage my younger self is to see things that others don't see.
Well, now you have the benefit of experience, but also so much runway in front of you in the Indian market and growth story. Sitting here today, what do you think you see that others don't yet see?
I would say now India's a lot more explored than in the past. But I do feel that we underestimate what can be done on the long term and overestimate what can be done in the short term, right? And it's not available in many markets. So that compounding of that is very, very interesting. For example, in 2013, we did our first buyout. The entire market was $2 billion. In 2023, the entire market was $10 billion of total buyout. And there is this forecast that says by 2030, the market will be $50 billion. I still think that $50 billion is an underestimate, and we will overshoot that $50 billion because last year we did $15 billion worth of deals. If those deals turn 2.5x by 2030, the secondary portion alone will be $35 billion. So that $50 billion is also underestimated. So that size of the market is still underestimated. I also think that the extent of private wealth opportunity in India is also very strong. The infrastructure segment in India is vibrant, so there is opportunity in India. There are many white spaces that perhaps are not as visible today.
You mentioned something important, which is really thinking about time, both in the context of the long-term time horizon and then the shorter-term time horizon. And people often overestimate one short-term and underestimate the long-term. How do you think about underwriting in the context of time? Because timing matters so much when investing. So how do you think about that concept?
So the way I look at transactions is when I'm underwriting is really, what is the risk of capital loss? And can I protect? So we are actually inverting the question.
Is that a harder mindset, though, to invest on when you're operating in a growth market?
I don't feel the pressure of underwriting. See, that's also the benefit of being in a regional platform. That, if India is overheated, we don't have to do anything in India in 1 year.
What do you think your investing colleagues and peers can learn from understanding the Indian private equity story?
I would say that the biggest learning for us is to be sector focused and control buyouts. To do buyouts in India, you can't do buyouts in every sector. You have to pick your spots and develop that expertise. So what we did is really build that industrial advisor network, build that network of management teams, and that focus on that buyout. There's so much underpenetration even today. And I think we'll all be surprised at what can be done in buyouts in India.
What do you think the Indian private equity ecosystem can learn from its more developed counterparts?
In India, I would think that the importance of getting exits. Internationally, it's a big focus. For us, it is a big focus. The second is really the value in managements and management team members and industrial advisors, and what a transformational manager can do to a business.
Well, we're here in Stockholm, where when you think about it, you think about some of the networks that have been created from the likes of Spotify, Klarna, right? People go off and then start other businesses. That's obviously more in the startup ecosystem. But on that point, are you starting to see the same type of ripple effects of the growth of India's private markets and entrepreneurs creating businesses, that over the next 10, 15 years, as the demographics shift in the right direction, so too will the number of entrepreneurs and the ecosystem at large, in terms of the number of people who are business builders and can help build businesses just from the sheer growth of the economy that you've seen?
Yeah, yes, definitely. There are so many more entrepreneurs in the top 500 companies in India over the past 10 years than they were in the past 25 years. So that entrepreneurial culture in India is very strong and strengthening. Some of our brightest graduates from our top universities, are looking at doing their own startups.
And that, I imagine, over time will evolve into the private equity ecosystem as well. So over time, as companies mature, then you'll start to see an even more vibrant private equity ecosystem.
Yes, we believe that some of them will mature and be targets for us eventually, especially in the software sector. In software, enterprise software is a sector where India is underrepresented. There's a lot more exciting companies coming up today in that space, and we're tracking them as well.
So I want to go from the macro to the micro as we end this conversation. So I think the macro story in India you've laid out quite well. From a micro perspective, is there any particular sector, space, investment trend or thesis that you're most excited about going forward?
I would say that healthcare is a theme that we are really excited about. We have 2 investments in healthcare so far, both of them done really well. One is the largest gastro hospital in India, AIG. The second is the number 1 IVF chain in India, Indira IVF. So healthcare is a very exciting sector. And our healthcare team is really busy looking at multiple opportunities. Pharma as allied to healthcare is also an interesting opportunity. India is one of the biggest pharma segments globally, which is both domestic as well as international. Not a lot of people know this, but India has more FDA-approved pharma manufacturing plants than the US itself. And then there's a vibrant domestic market as well. So healthcare, very resilient, very underpenetrated, and also very purposeful because it impacts the lives of so many people.
And you talk about billions of people in that economy alone, what that does to their lives. They live longer. That helps a growing middle class. All of those things must be interlinked and probably make you think about some really exciting things from an investment perspective.
Yes, definitely. I think one of the most interesting aspects of my job is really the impact that we can create on our companies and on our communities. We have more than 175,000 employees in India, and these 175,000 employees make us one of the top employers in India. 40% of those employees are women. Many of our employees are first-time college graduates from their families, so they go to a shiny workplace and have the opportunity to live overseas. And so that transformation it costs in the lives of these people has really been great. And during our investment horizon, each of our companies has actually doubled headcount, in some cases even more. So overall we would have created, thousands of jobs, and which means, more mortgages that we fund, school fees, and so the fact that so many families depend on us, and for their to build their lives is really it's really what makes us excited, and it gives us purpose to our lives.
Well, it's more than capital.
Yes.
As you've shown, the opportunity is so massive in India, but there's also an opportunity to do more than just provide capital and really build an ecosystem, build an economy. And it's exciting to see where things are headed. So, Hari, this is a fantastic conversation.
Thank you, Michael.
Thank you for listening to this episode of The DNA, Capturing Culture. You can stream all the episodes on your YouTube channel at @AltGoesMainstream AGM, or read about the episode at my Substack at altgoesmainstream.substack.com. And of course, special thank you to EQT and the executives that shared their stories and perspectives. Thanks a lot, and have a great day.